Where does the money go? During a recession. Uncovering the hidden flow. When a recession strikes, it often feels as though money simply vanishes. But in reality, money doesn't disappear. It moves. Understanding where it goes can help you protect your wealth and even find opportunities amid the downturn. First, let's address the stock market. During a recession, investor confidence wanes, leading to sell-offs. This isn't money evaporating, it's a shift in valuation. For instance, if a company's stock drops from $100 to $70, the perceived value decreases, but the actual cash doesn't vanish. It moves to those who sold before the drop. So where does this money go? Often, it flows into safer assets. Investors seek refuge in government bonds, gold, or even cash. These are considered safe havens during economic uncertainty. For example, U.S. Treasury bonds are backed by the government's credit and are seen as low-risk investments. Gold, a tangible asset, has historically maintained its value over time, serving as a hedge against inflation and currency fluctuations. Another destination is foreign markets. If the U.S. economy is struggling, investors might look abroad. For instance, Asian equities can become attractive due to their growth potential and relative stability. In 2025, some analysts suggest that Asian markets may outperform their U.S. counterparts, as these economies have more room for monetary and fiscal easing, and their equity valuations are currently modest compared to elevated U.S. valuations. Consumer behavior also shifts. People tend to save more and spend less, leading to decreased revenue for businesses. This reduction in spending can cause a ripple effect, impacting employment and further slowing the economy. Businesses, in turn, tighten their belts. They may delay investments, reduce inventory, or cut costs to preserve cash flow. This cautious approach can lead to a slowdown in economic activity, but is often necessary for survival. Real estate markets can also be affected. During recessions, property values may decline due to decreased demand. However, this can create opportunities for investors with available capital to acquire assets at lower prices. Real estate investment trusts, REITs, can be a way to invest in real estate without directly owning property, offering exposure to the market with potentially less risk. It's important to note that while some sectors suffer, others may thrive. Industries like utilities, healthcare, and consumer staples often remain stable as they provide essential services and goods. Investing in these defensive sectors can help cushion a portfolio against recessionary pressures. Understanding these shifts is crucial. By recognizing where money flows during a recession, you can make informed decisions to safeguard your finances and potentially capitalize on emerging opportunities. Diversifying your investments across various asset classes and geographies can help mitigate risk and position your portfolio for long-term growth. If you found this insight valuable, consider subscribing for more content on navigating economic challenges. Share your thoughts in the comments. How do you plan to adjust your financial strategy during a recession?